Good morning and welcome to the podcast for Monday the 11th of February. We'll start by taking a look to the week ahead. It certainly on paper should be a quieter week for markets. We have many markets around the world that are closed, many in Asia based upon the new year there. The US markets also looking to be closed for Washington Day in the next few days. So just taking a quick look at the diary for this week and just a couple of features for the UK. The first feature we'll talk about is OPEC, the monthly oil market report. We will take a look at the oil price. It's quietly becoming a feature of markets that the oil price is creeping higher at the moment. Tensions in Iran certainly helping that particular price higher in the near term. So we'll need to take a look at that, particularly in light of sterling's weakness. We'll hear from Barclays tomorrow. Now this is a scheduled announcement for their results, but we'll also hear from the newish chief executive who for the last few months has been plotting the look forward for Barclays to become for what I refer to as an environmentally cleaner bank. They'll be ridden themselves of many of the activities that have left a bad taste around Barclays. Tax saving schemes, trading, agricultural, soft commodities, those sort of areas are expected to be cut back or eliminated in that particular round. So he'll be giving that speech tomorrow. There's also the weekend talk that around 2,000 of the 23,000 employees of Barcap will be being made redundant, so some cost cutting coming there. That's fairly consistent with what we've seen from the likes of UBS towards the end of last year. On Wednesday, the Bank of England will be publishing its quarterly inflation report. The number will be published the day earlier. Again, inflation is proving to be a little bit of a difficult thing to control. The number still well above target, and that's again being driven largely in January by some strong gains in food prices, so that will be building into the inflation report on Tuesday. We'll talk more about that during the course of the week. And then later on in the week, some big company numbers out. Tullow Oil is one which we do follow here, and we'll also have numbers out from Royce, which is on the feature. Just a quick look back to last week. In the main, numbers came through, were generally well received. The US markets indeed sort of held quite steadily last week. We'll take a look at some of the European markets that wobbled in one or two places, but the US markets were strong, driven by strong corporate earnings. We have a research note out on a followed stock, Cummins. They published results last week. Well received. This is one of the largest companies in the world for fuel-efficient diesel engines. They export their products to 190 countries around the world, and the stock trading towards the high at around $119, and we updated our note on Cummins for last week. So just turning back to some of the stocks that we think are featuring at the moment. This is Royal Dutch Shell, and just to notice that despite reasonably strong equity markets, Shell shares have been in reverse, down around 8 to 10% in the course of the last few days. That's despite numbers that they published. The results themselves were a little bit below expectations, but the forward-looking guidance we felt was quite encouraging. So this 8% drop back in the price we think represents a buying opportunity. So that's one of the features we have for this week. And again, we'll come on to Brent crude shortly and have a look at that price, but the strengthening price at the backdrop of oil should be quite favourable to that organisation. In terms of currencies, we did see the euro pull back last week, and really the principal reason for that was this growing situation in Spain around Prime Minister Rajoy and allegations that are being levelled against him. It certainly caused the 10-year yield to move higher in Spain and also Italy, and caused certainly quite a sharp wobble in equity markets for both of those earlier on in the week. Certainly things have calmed down there over the latter part of the week, but it does demonstrate that these markets can still come to shock us and still remain very sensitive to any negative news that's coming out. We also saw the ending of the ban on equity short selling in Spain, and so it's interesting to note that as soon as that ban was lifted, we did see quite sharp falls in equity prices there. This is the euro, and around 136 it sort of peaked out, 137. We're back down to sub 134 at the moment, so probably some welcome relief, I suspect, for some at the central bank there. That followed President Draghi's comments as well around the euro. In terms of the US markets, we can see there that the S&P index had quite a strong week, as I mentioned, on the back of the corporate earnings. In terms of the Japanese index, again, just a little bit of profit taking there, and as pointed out, we've had Asian markets close overnight. So again, the FTSE just slightly shy from the peak markets. We did have a sharp drop on early part of last week, but it didn't lead to too much panic selling around, and indeed we did see sort of quite a healthy bounce back. So I think the underlying tone of equity markets remain quite strong. In terms of stocks to watch out for this week, just a quick look at the Barclays chart at around 301. Really the key here is how the perception of Anthony Jenkins' new sort of strategy for Barclays Bank is received by markets. That will be very closely watched. And just finally onto that chart of commodity, this is the Brent crude price, and trading up to 9-month highs seen last May, so really sort of fairly consistent trend there now of rising oil prices. Just to put that in some sort of context, what that means at the pumps, we've obviously seen a weak dollar over the course of the last 3 weeks, weak sterling against the dollar over the last few weeks, and so particularly when you relay this back into the price at the fuel tanks, it looks like petrol prices have increased by around 10% during the course of the last 3 to 4 weeks for the UK consumer. So we need to watch this. This is clearly a material input cost into some of the inflation data. So the Bank of England have got a big job on their hands to control inflation, and they'll be talking about that on Wednesday.